We've been talking about this all morning about Fitch possibly downgrading the U.S. credit rating. So right now, short-term bonds, they are attractive. We just mentioned the yield on the 1 month hitting almost 6%, record levels. But at the same time, the possibility of default makes those shorter-term bonds less attractive. And the possibility of default also makes stocks less attractive. So give us a sense, what strategy would you advise right now when it comes to bonds? And what's your outlook when it comes to rates on bonds?
Yeah, so I think what we're telling investors and clients to remember is that this is a political situation that we've seen before as recently as 2011, 2013, and 2017. And an agreement was reached in all three of those recent events around the debt ceiling. So we think that this will get resolved. And so for a base case, we want to remind investors that this will get resolved. But for investors that want to avoid the volatility and the noise in the short term, we recommend extending duration in their treasury portfolios. So this doesn't mean going really far out on the curve. This means sort of matching what you've been seeing in the market, which is maybe moving out on the curve, maybe to the 1, the 2, or the 3 year in treasury exposure. So that's one way to sort of think about moving through this. But let's remember, the debt ceiling has been raised 40 times since 1952. So we will get through this. And some of those short-term spikes in rates are really only reflecting treasury bills that are going to mature next week. So it's a little bit hard. You really need to kind of sift through some of this.
Yeah, I think a lot of people are trying to sift through it right now, Joanna. We're going to get more to the short end of the bond curve in a second. But Robert, I want to come over to you. All this volatility, all this uncertainty, I'm sure a lot of your clients are asking you how they can protect their portfolios. You gave us some of your tips. I want to key in on one in particular. You say buy quality names, but you say when you're doing that, there's actually an opportunity cost. So what's the opportunity cost you're talking about?
Well, the opportunity cost is related to the time horizon. So when we've seen these situations in the past, specifically 2011, whenever we had a resolution to the debt crisis, markets recovered relatively quickly. So there was a pretty significant drawdown, about 15% or so around that time horizon, that decline in the debt ceiling in 2011. But it recovered pretty quickly. About 3 months in, most of the losses had been recovered. And 6 months later, nearly all of them had been recovered. So there could be an opportunity cost here by being a bit too cautious. But it is important to focus on time horizon and sort of separating out that 3-month window and longer term time horizons.
So, Robert, we continue to tell the audience back in 2011, we had the debt ceiling scare. The markets declined by 17%. But right now, what we're seeing from NVIDIA, especially in mega cap tech, it just continues to move higher and higher. Do you see that same risk this time around for a big dip in the market if these negotiations continue and we get closer and closer to this X date without an actual deal?
Well, that stress certainly is building, and we're seeing it in parts of the T-bill market, as you mentioned, around the maturity dates that are around the X date. But one of the things that's a bit different this time versus 2011 is there is this real dichotomy between time horizons. So you have the stress building in the near term over these negotiations and the X date and when the X date might actually fall. But on the other hand, you have some optimism brewing in my mind in terms of the economy's been pretty resilient. Inflation's been fading pretty quickly. And as you referenced, some of the advances in technology and AI specifically bring some confidence that profit margins might improve in the future. So there is a bit of an issue here in terms of focusing on the day-to-day of the debt ceiling and the longer-term optimism that's starting to build.
So, Joanna, back over to you. Speaking of day-to-day, there's some disagreement about when that actual X date is. Goldman Sachs came out with some research saying it would more likely be June 8th or June 9th. Basically a week after Treasury says and Janet Yellen says the X date would come. So when it comes to the short end of bonds, these shorter term bonds like the 1 month, as we mentioned, yield hitting about 6%. For investors, what's the real risk? Because as you mentioned, the debt ceiling has always been raised and the U.S. has always paid its debts.
Well, there's a market for someone that wants to take that risk, and a market for someone that wants to lay off that risk right now. So I think that's what's important is that you can take action in these markets, whether you believe there really truly is a risk of repayment from the U.S. government. I mean, the logic is that there probably isn't. When we looked at the very, very short end of some of these T-bills, what's priced into those yields that have been popping in the last 2 days is only about 2 days of payment risk. So when you kind of move it out even just another week, it looks more likely in the way that it's being priced that, the debt will be paid. So agreed that, there's a way to stay safe in treasuries, whether you're in the 3 month to 6 month, or even just moving out a little bit more for more comfort and a longer term view. But I agree with what's been said previously is we really need to kind of zoom out a bit from what we're myopically focusing on within this month.